This lesson is defining the daily range. Okay, the retail 24-hour trading day. Now, I teach through the MT4 platform, and everyone is aware that if you hold down Control and you tap the Y letter, it'll pull up the period separators for the respective time frame you have on your chart. And the retail version of the 24-hour trading day is not what we focus on, but I want to highlight the contrast between the two because this is what you see in a typical MT4 platform. The interbank 24-hour IPTA trading day is very different. So if it's going to be a high probability trade scenario that we're going to be looking for, it stands to reason we have to start with the same reference point that IPTA itself, the interbank price delivery algorithm, uses in referencing time. So we're going to have to use the same thing that IPTA does when we view price in the element of time of day. So when we see these retail delineations, and folks have these on your charts, that's pretty much a classic telltale sign they have no idea what they're doing, and they'll frame the day based on these vertical lines. What we're going to show now is how a interbank trader views price in relative terms to time. Okay, the first element we're going to break down is the Asian range. I get questions a lot. What is the kill zones? What is the Asian range? When does it begin? When does it end? All the things dealing with time of day. So this is the definitive teaching, so that way we can go through the rest of the lessons for April day trading. This is the only one you'll ever need to refer to. So if you've seen anything different in the past, this is the real one. Okay, every day at 8 p.m. Eastern Standard Time, New York time, this begins the Asian range. Every day at midnight Eastern Standard Time, New York, ends the Asian range. We will learn specific things concerning this range later in April. For now, I want to give you the beginning and endings of all the specifics that deals with the IPTA trading day. Okay, the ICT London kill zone. Every day at 1 a.m. Eastern Standard Time, New York, begins the London kill zone. Every day at 5 a.m. Eastern Standard Time, New York, ends the London kill zone. Now we're going to learn specific things concerning this kill zone later in April, but for now, again, if you're ever questioning what I'm referring to in terms of the beginning and endings, you have to have a New York time clock. So either on your smartphone, they give you an opportunity to do world clocks. Whatever the time is in New York, use the times I'm giving you in this specific teaching and set that as your beginning and ending points for all of the references in time. Okay, the ICT New York kill zone. Every day at 7 a.m. Eastern Standard Time, New York, begins the New York kill zone. Every day at 10 a.m. Eastern Standard Time, New York, ends the New York kill zone. We will learn specific things concerning this kill zone later in April, but again, for now, this is the actual times I use to hunt the setup. The ICT London kill zone for London close. Every day at 10 a.m. Eastern Standard Time, New York, begins the London close kill zone. Every day at 12 p.m. noon, New York time, ends the London close kill zone. We will learn specific things concerning this kill zone later in April. But for now, when I refer to London close, this is the time window. Again, always in whatever New York time is, whether it's daylight savings time or regular time, this is the times I'm using. The IPTA true day definition. Every day at 12 a.m. midnight, New York time, begins the IPTA true day. This is the beginning of the 24-hour interbank trading day. Every day at 3 p.m. New York time ends the IPTA true day 24-hour interbank trading day. We will learn specific things concerning this time range in April. But for now, know that this is the beginning and the ending of an interbank 24-hour cycle. Okay, so let's take a closer look at what we've outlined here. What we have is a true day for a Monday, April 3rd, 2017. We classify this as a IPTA true day open at midnight and Monday true day close at 3 p.m. New York time. You can see that there are very, very specific time elements being shown here. Not only are we blending elements of IPTA data ranges and PD array matrix, we're looking at institutional order flow, but now we have an element of time that it gets so precise, it's hard to deny how anyone looking at this chart can see there's an algorithmic pattern and it's related to time. Now, we're not going to go into PD arrays and all the institutional reference points, but I want you to focus at the time windows here. Look at the turning points that we see here. Look at the daily high and look at the daily low. Look at the swing points throughout the rest of the day. There's logical reasons for why price goes to these levels and why they go specifically and precisely to a one particular level or another. I want to add the 8:20 a.m. New York time. This is the CME open. Look at this line, draw straight up with your imagination and goes right to that little short-term low, and price rallies away from that. That is not randomness. Okay, I'm going to teach you a lot about 8:20 a.m. CME open that I did not give you in other teachings. This area here between the London and New York kill zones, this is London lunch. This is generally when we're not looking for any major significant price moves. Usually the market goes quiet or it continues in the path that is set for London open. Framing the day like this, you can clearly see using power 3, the open at midnight, small little down move in the Asian range, we would not be concerned with that. The up move on the Asian range resistance being broken out, the high of the day forms right at the beginning of the ICT London kill zone. That begins at 1 a.m. New York time. Folks that are using my free tutorials, they're waiting for 2 o'clock, 3 o'clock, and 4 o'clock. This is the actual kill zone I use. So the time window begins at 1 a.m. It ends at 5 a.m. Look at the high that forms at 5 a.m. at the very end of London kill zone. Exactly, right there. Now look at the New York session kill zone. We have a short-term high that's framed inside of that New York kill zone, but look at the low that forms in the actual New York kill zone. It forms at 8:20 a.m. CME open. I'll tell you what the CME open is later on, but for now, just keep that as a reference point on your own charts. The high that forms in the New York session, okay, there's a swing high that forms, and it trades down into the London close. London close makes the low of the day, goes in consolidation, it trades off the low for a close, or what I refer to as the New York close. When I say New York close, I'm referring to IPTA true day close. It just saves me the time of saying IPTA. So true day begins at midnight New York time and ends at 3 p.m. New York time. Now 3 p.m. is because bonds close, and the influence that interest rates have on the currency markets will have ended by then. The last hour, 2 o'clock to 3 p.m. New York time, will always encapsulate any movement that's related to FOMC. So interest rate announcements, FOMC minutes, all those events that take place around the 2 o'clock hour New York time, that's what encapsulates that last portion. No matter what happens in FOMC, generally the move is ended, or the bulk of the move is ended by 3 p.m. New York time. And that's how you frame the entire daily range, open, high, low, and close. And that's the delineations of each.
All right, so we have an old low here, relative equal highs. The market trades above that, then breaks down and takes out the sell side here. What does that make this range here to here? A dealing range. Now, how's that useful? Well, we're in a very long, protracted consolidation. It wasn't like a short little run from here to here. It was elongated. This is a daily chart. So this is a lot of time going sideways, essentially. But it took buy side and then eventually aimed for sell side. So dealing range high, dealing range low. Why is that a dealing range again? We took both sides, buy side and sell side out. What's the bias now? Bearish. All this range in here, we're looking for areas that anticipate a run back up into a premium. Short-term high, short-term low. It runs up into a premium here, sells off. It creates relative equal highs. Sell side's taken here. So once it has taken the sell side here, what's the market likely to do? Revert back to buy side. Even though it's bearish, where's the buy side? Like a neon sign, relative equal highs. Bumps up to it, then does what? You have now a new dealing range. You have a dealing range from low, because it took out the sell side, and the buy side's taken here. So your dealing range is from here to here. What is the usefulness in that? You're anticipating the market to trade back down to a discount and eventually to its sell side. Discount array below 50% of here to here. This fair value gap is a target. So you're going to be looking for areas once it sells off. Here's a fair value gap. Break lower, target, filled, sell side, relative equal lows, tags it. So now we have this dealing range from here to here. Why is that a dealing range? We've taken buy side here and sell side's been taken here. So from here to here, you start doing analysis inside of that range. Look at all the back and forth in here. And then we get to this level here and it's more energetic. When I see that, I identify this as the dealing range high to here, but I will refine it down to the most energetic price swing inside of the dealing range. So I'm going to use this range here from high to low. How's that useful? From here to here, I'm going to be looking for a equilibrium price point or premium to go short, because the bias is what? Bearish. I publicly made that known even on YouTube. I said we're entering a seasonal tendency here, where we go into May where it's bearish. Did it deliver? Of course it did. Now, this gap here, we see it trade up into it here. Sells off, comes up into here, fails to go into it there. But look at all these opportunities where it could have filled in that gap, but it didn't. Broke lower. That indicates to me that this is a breakaway gap. I will talk about gaps in its own topical study, but for now, this is a breakaway gap, meaning it's going to most likely stay heavy and run where? In our bias. What's that direction? Lower. So we have sell side below here now. So we expect price to trade lower below that. It does so, and then keeps on trading lower and creates a short-term low here. Rallies back up into a gap, drops down once more, takes sell side. So now buy side is where it's likely to revert back to. And from this high to that low, that's our focal point for our study. So inside this range, I want you to think about what you see. All right, so I have the chart kind of aligned so we can focus on that range here. So inside that range, again from here to here, we have a buy side liquidity pool right there. It trades up and purges buy side. Why is that likely to occur? Because we're bearish. We're going into a seasonal tendency where the market's likely to trade lower. So anytime it runs back above buy side liquidity, it's likely to sell off. Once it accumulates those buy orders, it's going to target what? The sell side below that low here. And it does so here. So sell side is now purged. So this is an area where if you're a swing trader and you don't want to be a day trader, because a lot of folks are like, hey man, I can see that intraday trading is amazing and it's awesome and you and your students are able to do a lot of things that are highly precise. I just can't do it, Michael. I don't have the time. I don't have the lifestyle, my requirements at my job, my business, I'm in school, I just can't do it. Give me something I can trade with on a higher time frame daily chart. This is it. How is this any different from what I teach in the lower time frame? It's simply changing the time interval. Everything I'm teaching you is fractal. The algorithm runs across all the time frames. All of them. It starts at a higher time frame, runs its way down through the time frames. And it refers to all these locations. The algorithm is highly complex, but the concepts of engaging with it is not complex. You have to be specific and oriented to the high level of detail to navigate each one of these time frames and put things in their proper place and context. So in short, if we're bearish, I like to look for a short-term high taken out and accumulate short positions. Who's accumulating short positions above old highs? Smart money. They held price there. Why? Because they were allowing traders to engage this as what? A bull flag. Retail sees that. Oh, look at this doji down here. It ran up. Support is now being found here because that was resistance. And that is now what? A continuation of a buy side run higher with a bull flag. It's going to run for this area here because that's resistance. And the opposite took place. We were bearish here. The market trades lower, attacks the sell side, runs in, spends time down here, and then we have Friday's price movement. So let's discuss liquidity a little bit deeper. This is what the algorithm does. Okay, I want you to think like this because this is what the algorithm, when it runs certain macros, macros are a short list of orders of instruction. Do this, do that. Okay, the if then or that logic behind how the price is being designed, delivered, and booked. We have now a dealing range. This low was taken out here. This high was taken out here. So now we have this high down to that low. How is that useful? Well, if we strip this away, so we're looking inside this range here. Okay, this is our specific dealing range. What do you see? These are relative equal highs. It went above into the fair value gap with this here, and we never were able to go higher. So I'm looking at that as that's the cap on the marketplace, and it's likely going to be a breakaway gap. That means it doesn't fill right away until it fulfills lower level objectives on price down here. So what do you see in here? All right, so we have this high to that low. Why am I picking this high? Because it has the most energetic price run away from it. It's the most recent one that has that energy going lower. The delivery of the candles moving away from it quickly. That's what I'm really getting at. So I'm framing it with the logic that this is likely to stay open, not rebalance, and the market's going to drive lower. So our range from here to here, that's what I'm measuring, and equilibrium's here. So above that level, this level here, what are we looking for? Well, we're looking for buy side. But classic support and resistance idea is this. We've taken out this low, relative equal lows. Okay, this break below it here is shallow and it's short-lived. And then we broke down aggressively through it. So classic support and resistance traders are going to do what? What are they going to be thinking about that low once it broke through it here more meaningfully? They're going to assume that that was support broken, now turn what? Resistance, right? So they would expect price to trade up into that level right here and then trade down from there. Not understanding any of the logic as to why it would do this at all. That's narrative. That's the reason why retail traders suck. Because they just simply look for support and resistance, or they look for patterns for pattern's sake, and they're fooled by randomness. The algorithm is not random. So I teach you to look at a range and define it in the scope of premium to discount. Equilibrium is here, and if we're bearish, we need the price to get to equilibrium or preferably higher than to go short. In this shaded area here, why did it not just simply trade back to that low and go lower? Why didn't it do that? Think. That's our last up close candle right before the energetic move lower. Inside the context that this is likely a fair value gap that is going to stay open. Why? Because it had no ability to get up into it, close it at all. So that changes the fair value gap to what? A breakaway gap. Breakaway gaps remain open until lower level objectives are fulfilled and delivered and booked. In other words, it goes lower to a specific price level in the discount. Then at a later time, it might come back up to here, but it could be an undetermined amount of time. I don't know when they'll come back to fill in a breakaway gap. And if it's a bullish market, everything I just said, just reverse it. This last up close candle prior to the move lower and taking out that dealing range low, that is my ICT bearish order block. It trades lower, comes back up, doesn't really quite get back to that old low, sells off again, then it comes back, ramrods this low here, goes above it, and then consolidates. So anyone that would have expected this little bit of fluctuation through, this would have wore them out. These are days. These are days of trading, S&P. Shorts are going to be scared. It's probably going to go higher. Why? Because they see a bull flag. Run up, consolidation, and they expect it to go higher. We're bearish. We're in a premium market, and it's going to a bearish order block. Now price is likely to drop lower and reprice and target what? What's it going to target? If this is your trade, what's it targeting? Well, think about what I taught on this YouTube channel, flagship pattern, the optimal trade entry. From high to low, 79%, 62% retracement levels. That's here. That's my optimal trade entry. So you can use targeting approaches where you put the fib on the bodies here and here, the lowest of the opener close and the highest of the opener close, and your projections down would be red in here. And I'll leave that for you to study and do on your own. But we have a fair value gap that's left open, bearish order block, a dealing range that's been broken to the downside. The only thing we've done is retrace back into a short-term premium, and retail traders are going to see a bull flag. We're looking at it to go lower. What's it going to go lower for? Before we get into that, we have a short-term low that's taken here. So we had sell side here, and it starts to rally back up. What's it reaching for next? It's going to revert back to buy side. That's this here. That's why it's not going to go to simply that level and go lower. It's going to go deeper then to clear off all the buy side liquidity, so that way it can absorb that buying orders and translate that to a short position for smart money. So the counterparty is the buy side being attacked here, so shorts in the smart money camp can then target that low down here. So we have buy side taken here, the sell side was taken here, so now the sell side changes to here, because the dealing range is now defined by this low and this high, because buy side was taken on this high, sell side was taken on this low here. So we have a dealing range here. How do we find that useful? We're bearish. So even though this is a fair value gap close to around the equilibrium between this low and this high, that simply would just be a partial. And we hold for what? Sell side to be attacked. But look closer in here. What do you see? Let's zoom in. So here is that area here. And inside this own area of shadedness, I'm taking your attention to the short-term low here. So we have a short-term low here, and then it gets taken out, and we have this low here, and it starts to rally up. Look close. Do you see that this is a swing low? Again, these are daily candles. They're not lower intraday charts. We have a low that takes out sell side here. Runs down, creates that low. One more smaller attempt to go lower than this day. It does. Then the following day, we open, trade down, and trade back up. This is a swing low on a daily chart. After we've taken out sell side below here, and we have a short-term sell side liquidity pool here, which it runs down into, and then creates a swing low. So we're in a discount inside of a discount. Think about that now. If sell side's been taken here, and sell side's been taken here, what's it going to revert back to? Buy side. Where's that? Swing high on the daily is here. So if it's going to go here and run to that level, buy side is simply not just at that level. What's above that? Bingo. Our gap. We've been talking about that gap for a couple weeks now. The easy low-hanging fruit objective, 3880, I gave that on Twitter, and I'll talk about that in a couple minutes. But notice how we had sell side taken here, and then the market reverts back to buy side and to an imbalance. That gap. Large range day. Well, how did we know, or how could we have known, that Friday was going to be a large range day with an up movement? Well, let's dig into that now. All right, so we finally made our way down into the hourly chart for S&P. Here's our gap from the daily chart that's noted here, and here's that old sell side liquidity pool. And we dug down into that, and I'm going to add some day dividers here so that we can get a little bit of context. I want you to look at the profile of the week. So on Monday, we opened from all of this nastiness here on the previous week. The market starts right away on Monday, just starting to go higher, repricing, going higher. No one can go short, no one can go long, because it's just constantly just going higher. If you fight that, you're dead. You got to wait for some kind of displacement. When does that occur? On Tuesday, we have a little bit of a movement here, and then breaks down. Then sell side is taken, and think about what I showed you on that daily chart. We now have a swing low. So on Thursday, we can anticipate the market doing what? Coming back down to a discount, rallying up. But Friday, notice what we have here. The market's already moved above all the consolidation here. It's not likely to do what? Have a sharp movement lower. It's not going to take sell side out because it's already done so here in the consolidation. It's already worked into this fair value gap here twice, but the sell stop run there, taken out here, digging deeper into this imbalance, leaving the bottom portion of that imbalance open, making it what? A breakaway gap. So it's indicating that it's not likely to have retracements of any magnitude that would see this revisited again. So we had this level taken out here, retraces back down into a short-term discount from low to high, fair value gap, digs into this here, and then once more on Thursday. It rallies, comes back down in, retraces, and this is where I'll talk about what I was wrong about on Thursday, but right about the second part of the day. But Friday, we just started consolidating, had a little bit of movement on the lower time frame in London, which I'll show you, and then off to the races because the market only had Friday to fulfill a run into that gap. Everybody knew about this gap. Nobody knew when it was going to hit it until around Thursday. This imbalance right there, that's what I used to justify the run up into 38.50, and there's two setups that were made available if you were looking for it too, and we'll cover that now. So because it's consolidating, I don't expect it to drop down because everybody wants it to go oversold. When the market's this close to the gap or some premium array, and you only have that day before the week closes, when everybody with any insight would know that this is where it's drawing back up into, because it's a gap. It's a real gap. Actual gaps have a tendency of filling in. All right, we're going to drop down into a 50-minute time frame. You can see the fair value gap here. We drop down into it in London, consolidated into another run into that fair value gap in London, and then aggressive run right at the 9 o'clock hour. Market was not going to give anybody an opportunity to see a deeper retracement. And inside this run, I'll show you what it looked like also, but this is the low-hanging fruit objective. Low-hanging fruit is the easy objective. This is how I teach my students now. Obviously, the gap being closed entirely would be up here. Well, it may not have done that on Friday. We only had just Friday to get up to this level. It may have just fell short of it. So the low end of the fair value gap is down here. So what's the nice round 10 level into the gap? The first one, 38.80. That's why I elected to use 38.80. Right away into the 1 minute chart, you can see at the New York session at 9:30 equities opening, we see a run aggressively here, fair value gap. It drops down into it. Buying opportunity if you were trading with the New York 9:30 opening and the target, that gap, the shaded area up here, you could be a buyer here. The market rallies up, creates another fair value gap there. Again, thinking about that weekly profile. So what's the benefit of knowing what the weekly profile is going to be? Knowing where the draw on liquidity is, where's it likely to go? I taught you that in this lecture. Because of the weekly profile, that gap that was looming above on the daily chart, which is shaded here. The fact that we only had Friday to get to it. And the market was just basically saying, we're not going lower. We're not going to go any lower. And it kept taking out buy side, but not drawing down and completely breaking lower. It would go for a short-term area of sell side, but then immediately rebound and go higher to take out buy side again. So what that was indicating to me as the analyst, they're gravitating towards this gap. So you wait each day, because anything apart from what I'm teaching you here, it's gambling. And it's just circumstances that led to you just being right that time. Until next time, be safe.